Hi, good afternoon. And thank you for staying this long, for the people that are not leaving yet. My name is Luuk Strijers, I'm Dutch. I'm the CEO of Deribit, and Deribit is based here in Dubai since a few months, and before that we were based in Panama, and originally we were founded in the Netherlands. The Netherlands is home to options, as some of you might know, so there's a lot of options firms and a lot of spin-off firms trading as a market maker, and platforms like us originating there as well. So we've been around for quite a while. 2016, we were one of the earlier ones, and we focused on options when no one else did. And markets really started growing in 2018, 2019, so it took quite a while. Nowadays, we are the biggest. We have 85% of the market, and essentially there's no one else that has a decent market share. The rest all have 1-2%, which includes miners, OKX, etc., including DeFi spaces, all the big protocols all together have 15%, we have the rest. So just some numbers, all staggering numbers. 80% of this is institutional. So retail is a few thousand people, and then we have a few thousand corporates making up for 80% of the business. So it's really, let's say, traditional firms, all the big names that you might know, Galaxy, Brevin Howard, etc., trading crypto, and they would trade on our platform. So that's us. So slightly different than most of the people here in the ecosystem, because typically all of this is targeted at retail, and we are the opposite. We have a complex product. If you log into our system, you see 1,000 products, you see different expiries, you see different strikes, you see Greeks, deltas, gammas, vegas, stuff you've never heard of, which either you love and you fall in love with it because it's like an amazing product, or you're overwhelmed and you'll never come back. So that's our difficulty, offering a product that's rather complex, but you can't simplify it. So it's simply rather complex, and it's there to stay. So how many people actually know what options are? So that determines whether I explain it a little bit. Okay, let's say half. Let me run through quickly. So options are different than perpetuals, different than futures. Options are a niche product that allows you to target. So for example, an option is an option to buy, a call option to buy crypto, let's say Bitcoin, at $50,000 with a certain expiry date, so let's say the end of June. So that means that there's a strike, a price level, above which you are profitable. So if price today is, let's say, 60, that product would be worth approximately $10,000. Converted into crypto, that would be let's say 1.15 of a BTC in terms of value. If BTC rises and grows to, let's say, $100,000, the P&L would be $50,000, which is half a Bitcoin at expiry. So you can target using prices, but you can also target using expiries. So you can buy products that expire in June, in September, in December. If you think because of the election, because of the halving, because of whatever event you believe in, the market is going to act or react, options are perfect instruments to buy or sell, because of the halving, you might think that, let's say, in 3 months' time, a certain thing might happen, the market will rally, and for you to benefit optimally from this rally, you can either buy spot, which is heavy in terms of capital, or you buy options, which is much cheaper. However, if the expected event doesn't happen, your product expires worthless. If the market crashes before that happens, so let's say $60,000, we move to $40,000 and then to $100,000, you won't get liquidated. So the key differences with most of the derivatives out there is that markets typically liquidate clients. So there's a margin. If you're out of margin, we liquidate you. For options, you have a right to do something at a certain moment in time. So if you buy an option, whatever happens in the meantime is irrelevant. At the measurement moment, we look at what happened to your product. Did it go up? Did it go down? And how much is your P&L? And that's the moment it matters. So you won't get liquidated in the meantime. But if at that moment it didn't happen, it's worthless. So lower capital outlay, more precision. So you can say a $50,000 strike, a $60,000 strike, a $100,000 strike. Of course, the 100,000 level is further away. So the chances that that will happen are smaller than something expiring at $60,000 because we're already trading above $60,000. So the premium for a $100,000 option will be smaller than the premium for a $60,000 option. Then if the markets are moving rapidly, volatility, the premium gets higher because the likelihood of some event to happen is more likely if the market moves a lot than if the market moves a little bit, because it's never going to reach $100,000. So high volatility means high option prices. Leverage, of course, it's a low capital outlay, so you can get bigger upside. Hedging, you can look at this like a fire insurance. If you think your house might burn down, you buy a fire insurance. If it doesn't happen, you're fine, you're happy because your house is still there. The same applies to a portfolio of Bitcoin. Let's say you have 10 Bitcoin, you're afraid of the halving, you're afraid of the elections, you want to protect your portfolio, you buy put options. If the market goes down, your Bitcoin loses value, but the put options gain value. So on a net basis, you're flat. A lot of large funds, large asset managers, portfolio managers, hedge funds use options to hedge because they have long-term views, but they're not necessarily certain about the halving effect. They're not necessarily certain about the ETF effect. So to manage this exposure for the coming 3 months, they buy some options. But long run, they don't because they're committed to what's going to happen next. Event positioning, halving, elections, etc. So when markets are boring, not a lot of volatility will happen. So volatility will decline and markets won't be that exciting from a Deribit perspective, from an options perspective. But if the ETF gets announced or gets rejected, the halving is coming, the elections are coming, people are getting excited. And some people believe in a certain storyline and other people say, no, it's a buy the news, sell the rumor, buy the news story. Everyone has different views, causing the markets to be more volatile and moving, causing more options to be traded. So the left chart, and if you look at data from 2016, it's going to look worse. That's the evolution of options. So we started out really, really small, tiny, a few $1 million a day in turnover. We're looking at $1 billion a day, but if you look at $1 billion a day in turnover, so in March we traded our best month ever, which was 142 billion in turnover. Out of that, 2/3 was options. So that's a few $1 billion a day in options turnover, but all of that turnover is only 2-3% of the overall market. So derivatives are massive. And if you look at derivative markets globally, in the US, in Korea, India, Japan, wherever where there's derivative markets are popular historically, you'll see that a big chunk of the volumes is options. In the US, options is bigger than spot. Options is approximately equal to futures. In the crypto space, it's still small. Even though we think we are big, relatively speaking, we're still small, but growing. You see that trend. So if you believe in that storyline, the market will mature. Eventually, family offices, hedge funds, and whatever, everyone will come. This number will grow. It will grow 50 to 100 times to be in line with those traditional markets. And in order to get there, we're doing a lot of things. ISO certification, SOC 2, a lot of things that certify our business that you wouldn't care about, but that enables us to onboard institutional flow, which is key for us. We have a VARA license. We haven't activated it yet. In a few months' time, we'll start operating under this Dubai regulatory regime, which allows us to trade spot and derivatives here in Dubai. All of these checkboxes, audited financials, system penetration testing, etc., puts us more in line with Nasdaq, CME, Eurex, etc., more in line with traditional markets, and more enables us more to be the recipient of flow. So once these large firms, these large hedge funds, these billion-dollar asset managers start trading crypto, they will look around and they can choose either traditional markets or hopefully us. There shouldn't be any other choice because all the other markets wouldn't have the same qualifications. Those are our ambitions. We should be the alternative of choice, accepting crypto collateral. So if you look at big global markets trading derivatives, it's like platforms like CME, Eurex, etc., they don't accept crypto collateral. So if you have one BTC, you have 100 BTC, and you go to CME and say, can I use this as collateral for my trading? They will tell you to get lost. They only accept dollars. And for us, it's the opposite. We will accept dollars, we will accept treasuries, money market funds, but we also accept BTC, ETH, Solana, whatever you have, yielding stablecoins, USDC, USDT, etc., etc., etc. So if you embrace the ecosystem and you have all of that stuff in your portfolio and you want to leverage that, you want to get yield generated, you want to buy options, you want to sell options, you want to trade using futures, etc., we are the go-to platform of choice. So this is the left is us. So I discussed a few of these items. We're more like a typical crypto, typical traditional exchange with extras. And we try to expand these extras. So from a latency perspective, from an engine perspective, how fast can we update orders? You can imagine that if you are a platform trading spot, let's say one coin, and there's 10 market makers quoting, if the market moves, 10 market makers will send one new bid and one new offer. And if it happens quickly, they'll send whatever, 10 times as many, 100 times as many, but that's about it. 100 messages, 1,000 messages, and then the order book is updated and everyone has priced again. If an options market has to adjust or has to reflect market moves, there's, let's say, 25, 30 market makers quoting 1,000 instruments, all sending 1,000 new bits, 1,000 new asks. That's thousands of updates per second. So from an engine perspective, you're looking at a totally different market setup. We're not cloud-based. We have dedicated hardware. We have servers in London. We have multiple servers, the best stuff money can buy, faster than our servers. They're not available. Our clients plug in cables to make sure that they have the lowest latency connection, to make sure that they can cope with different market circumstances. If the market crashes, which, as you know, happens often, they need to be able to update all of these 1,000 instruments. For that reason, we have stuff like multicast. It's like the fastest data protocol out there. No one else has it. We have market maker protection, so we pool orders on behalf of market makers should certain circumstances happen, mass quotes, etc., etc., etc. So the market is growing, and our market share is slightly dropping, as you can see. So, and over time, we will slightly lose more. So we have 85%, and in, let's say, 2-3 years' time, we hopefully have 70% of a much bigger market. Why are we losing? Because some of the others are activating as well. So platforms like Binance and et cetera, have 100 million clients each, and if they send 10 emails, some of these 100 million people, perhaps some of you, will trade. If you trade more frequently and more actively, and you actually like the product, you want the best liquidity, but you actually want to do more strategies, you want to buy some calls, sell some puts, some more advanced strategies, some futures, delta hedging, etc., 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 that's when you come to us, because we have the most advanced margin engine, and we offer best-in-class collateral management. So these markets activate some people, and the market is getting bigger and bigger. The market is also growing because new people enter, the big traditional firms, the hedge funds, etc. So the market is growing, and we lose slightly. As you can see on the right, March has been an amazing month. April won't be the same, but if you believe that the trend will continue, and you believe that whatever Bitcoin will be $60, $70, $100,000, you see the close correlation with our turnover. If it trades at $100,000, you can expect massive turnover on the platform as well. Some numbers, you can forget about these immediately, but these are mind-blowing numbers. So we have, mid-March, $23 billion in open interest. In 13 March, we have 12.7 billion in ETH open interest. So together, plus the futures open interest, we have around 40 billion in open interest just before the expiry. So options expire every day, every week, every month, and the bigger the expiry, the bigger the impact, and the bigger the market activity as well. So the quarterly options, March, June, September, and December, are always bigger. So half of this stuff expired in March. That means that everyone that's hedging needs to unwind their hedges, etc., etc. So these unwinding moments, these expiring moments, are really big for us. But 40 billion, out of which 1.5 billion is futures. So we have a lot of options. You know us for our options market, but for example, we're number one in futures as well. So we have 42% futures open interest. The next one, I think, is Binance or OKX, has something like 30%. We're massive in futures, and the reason for that is that when options traders trade, when you buy an option, the counterparty will hedge using futures. So they will buy or sell futures, and therefore we have a big futures pool. So they go hand in hand. We're decent in perpetuals, so like, let's say, top 10, far from the top 1, which is Binance. But futures and options, that's us. And this is our logo. Do we have 1 minute? So a little bit of interaction or any questions? We don't do questions? Yes. Yes. So the question is, are we willing or considering to expand our product range and including on-chain, off-chain? We have expanded recently with altcoin options. So we started out with BTC, we added ETH, we added linear instruments, so USDC, USDT, and we recently launched Matic, XRP, and Solana options. We've just started out building it, and we just launched like a month ago. So we have expiries up until a month out. Once we get more success, we'll add 2 more months. We add 1 more quarter, and eventually we hope to have them the same expiries as we have for BTC and ETH, which is up until a year out. That will take a lot of effort because the market makers don't have the same volumes as they see in BTC and ETH. So we need to push them, incentivize them to quote tight, quote in the weekends, even when no one is trading. We need to have proper markets because if you buy today, you need to be able to sell next week as well. So you don't necessarily need to wait until expiry. You can also just sell those option positions. So we're building that gradually. We have 3 now. I think if we can build the ecosystem and we can excite people like you, we should have, let's say, up to 10. And once you have 10, there's always something happening. Today it's Solana rally, and then it's a Solana crash. Tomorrow it's XRP, whatever. All the time, some coin will be in the news. And if you have the big ones, if you have choice, you have an interesting platform. We do this as a centralized venue. We don't touch DeFi. The reason why we don't touch DeFi and a lot of on-chain stuff is that 80% of our business is institutional. And what they're terrified of is trading against people they don't know. They don't want sanctioned Russians. They don't want terrorists. They don't want whatever, all of that stuff. The long list of sanctioned countries, the long list of individuals. They're terrified that they might have traded against them, and then next week, next month, there will be a headline of a big asset manager which should have the highest of the highest standards that traded against something they can't justify. And in DeFi, up until now, the gateway in is not, I think, of sufficient quality to make sure that will never happen. For us, we're also terrified of US persons. So we're very strict in onboarding people from wherever in the world except US. In the DeFi space, that's more tricky to safeguard because there might be US person trading DeFi, and if we interact with that whatever platform protocol, we might be at the risk of actually servicing US persons, which will open us up to massive fines.
Thank you.
Thank you for your question.